the Federal Reserve meets and gives its interest rate decision, is it going to be 25 or is it going to be 50?
100% 25. Yeah. There is no doubt.
There must be a trade that we can both do off this, because I'm 100% on 25 basis points as well. Welcome to the Market Edge, our monthly show where we talk through our market insights and trade ideas. What's come good and what's not.
We take a look at the one chart that we think is really crucial over the next month. And then we go through our planning and thinking of events that are going to be really important over the coming weeks.
So why listen to us? Well, being British, we don't want to blow our own trumpets, but...
Rich became one of Credit Suisse's youngest ever directors at the age of 30, as their head of equities emerging markets. Prior to this, McDonald spent 3 years as a junior fund manager for one of Europe's top hedge funds during the financial crisis. David's been a big name in the retail trading industry for 10 years and worked in fintech while trading his own funds and running a research firm.
Right, now let's take a look at the wins and losses that David and I have had in the last month. But first, we're going to go over to our meme of the month.
This meme of the month is quite funny, to be fair with you, because it's explaining really at the crux of it, the difference between the US and the EU. Now, the iPhone 16 has just been released, and outside of the EU, it comes with a set of features that you can't actually get in the EU. So let's have a look at them. So we've got Apple Intelligence, Visual Intelligence, we've got Genmoji and iPhone on Mac.
However, on the right-hand side, you can see the EU version of the new iPhone 16 with absolutely none of that, because it's all been banned.
It's quite funny, isn't it? Because Mario Draghi actually came out, I think it might have been on the same day or just the day before, talking about how competition in the EU has to get broader. You know, they have to sort of deregulate a little bit, because really they're lagging behind. You know, they're the first to regulate, but probably last to innovate, even if you compare to countries like India, China. So it's really astounding that this specific example is so blatant as to what is going wrong in the EU.
And one stat I did see from Draghi's paper was that, let's take a guess, how many companies do you think that have been started in the EU in the last 50 years that are now worth over 100 billion euros?
This, I think, is zero.
It is absolutely zero. And that's compared with 6 companies in the US that have gained over $1 trillion of market cap. So it really is, you know, killed by regulation.
I think it's also down to their capital markets as well. You know, in the US, money flows really, really freely, whereas in the EU, those capital markets aren't developed as much. It's the same in the UK, to be fair. Obviously, we were part of the EU for a very long time, so I think there are some connections still there. But I think they're really trying to develop these capital markets, but they can't do it purely because of the structure of everything. There's too much sort of burdened legacy, if you like. You know?
That's right. And it results in 30% of all unicorns being set up in Europe going to the US for funding, exactly as you say.
It makes sense to. You know, if you look at the composition of the FTSE, they've got a brand new tech department, which, to be fair, is led by a guy called Neil Shah, I think, who's doing a great job. But at the end of the day, you're still going to be fighting this battle whereby no matter what you do, it's still going to be more attractive to go and list or get funding in the US because they just want to give money more.
Let's just take a quick recap at our best ideas from last month. There's one stock that I really like, and that is Prudential.
I think over the next week or so, I think Intel has sold off way too much.
Okay, so let's look at our trades for last month. Now, we have one from the UK, we have one from the US. I'll go first. It's just been a bit of nothing really. So I was looking at Prudential last month. We had numbers from them. We had numbers from their peer AIA, and AIA was actually up 5% on the day. The Pru tried to rally, but then it just faltered. And we continue to see this. Anything associated with China is really struggling at the moment. And it's hampering the commodity space. It's hampering names like Pru, and it's also hampered BMW. BMW coming out with some poor guidance, and especially associated around sales in China. The stock down 11% on the day. So it's been a real struggle this month for any stock that has sales or a decent amount of sales in the Asian region.
Yeah, it's interesting you mention China and the related companies that are outside, because Burberry is a UK company that's really, really been struggling. And if you note the amount of sales that they get from China, it's literally so correlated to their stock market. You know, China sales, their share price. China's sales of Burberry goods are down so much. And so you can literally see and trace sales versus Burberry share price listed on the LSE. But my pick from last month was Intel. And I was looking at it from very much a mean reversion perspective. And I still think that it's going to come off, but really it's done nothing. I think it's trading just above $19 at the moment. It ticked up to 22. I called it at 20 and a half. So it's really gone nowhere, you know, and it's been turgid. I think now in the last day or so, the market's getting a real giddy up again. We've absolutely got a hell of a lot of momentum now. I think we traded, did we trade 5,700?
Let's take a look at the chart, shall we, of the S&P over the past month since we last did the show. And it's been so hard to make money because we came back on the Tuesday after Labor Day and you see that huge down move, the big red candle there, and subsequently followed by another sell-off on the Friday of non-farm payrolls. And then, like you say, we've had a huge turnaround. Now, David and I don't just meet up to do this once a month. We also regularly chat on WhatsApp. And if you see the last green candle there, around about the time of the bottom of the wick, David sent me a text saying, "I just want my mum. This is causing so much pain." And the market was testing that low that we had seen on the Friday beforehand, and all it's done since is rally, and it's been a face-ripping rally, hasn't it?
It's been lovely. I said on Twitter there was going to be a disbelief rally coming off, because the way that I was looking at it was, what else can we get that is bad here? Nothing. There was nothing else bad. And what we've seen since is, if you look at interest rate futures, they really priced in a 50 basis point cut, which people would say that should make stocks rally. But in actual fact, the question to ask then at this stage, when we're entering the cutting cycle, is why are they expecting a 50 basis point cut? Is it because they're expecting massive unemployment increases? But since then, we've seen that interest rate futures have actually priced out that 25 basis points, creating this calm and creating that lovely path of least resistance to the upside. So that is pretty much why I think this rally's occurred.
It's got a bit of a Goldilocks feel at the moment, doesn't it? The jobs numbers were good enough and the CPI was good enough that there's just that, at the moment, a Goldilocks feel. We'll come on to our preview for the Fed meeting later. Now, let's move on to our chart of the month. David, what have you got for us this month?
So this is new passenger car registrations, and it's down to, I think, the lows of 2020. But this is in what's meant to be a relatively good period, as we were just discussing, you know, that Goldilocks scenario. The Goldilocks scenario is not there for Europe, though, especially Germany. And I think this is something to really, really note. And this is possibly as well why we're seeing more capital flow to the US, whether it be in bonds, whether it be in equities, as we're seeing. It's because there is an opportunity cost of remaining in Europe. The US is just a better option. But Germany is going through a really, really bad period at the moment. You know, there's so much talk of plants shutting down from Volkswagen, BMW obviously having issues. Mercedes has actually been quite quiet, but you can see here that the new passenger car registrations domestically is a real, real problem. Things like the German Foreign Office talking about being proud of shutting down coal, but more so nuclear power stations. That is very, very telling to me as to where Germany sits right now in terms of looking forward. They're not doing well. They're really not doing well.
And do you think this is a longer term hangover from the Merkel relationship with Russia in the past and this reliance that they had on energy? Do you think the German economy is now feeling the after effects of that?
Yeah, definitely. And I think there's so much cronyism there as well. If you look at Gerhard Schroeder, who was a German. I think he was very high up in the German government for a very long time. He then became, I think it was either chairman or a very senior director at Gazprom, which is the Russian energy giant. And then you have to be wondering, okay, well, why is all of this occurring? You know, there is still flow, by the way, of nat gas from Russia to Europe. It just goes through subsidiaries like Kazakhstan, for example. And so we have to really, really be questioning what is the motive here, because no one's wanting nuclear to be shut down. There are very, very few people who are wanting this. And the other interesting thing, of course, I'm going to digress a little bit, is Ed Miliband talking about, the closing down of the power station just yesterday, or I think it was a power station, wasn't it? I've not delved too deeply. I just saw the tweet. And it's like you reap what you sow, almost. How are you meant to progress if you're not using these new technologies, but then you're going and complaining about things? It doesn't make any sense. And I think this is why people are bewildered at our current crop of politicians as well.
Okay, and moving on to my chart of the month. Well, I've gone back to our friends Andy Hart, that is fantastic with these kind of charts. And it's the blue line is the NASDAQ, okay, QQQ, and the white line is our friend from previous months, the Japanese yen. And you see it's gone through the lows on the chart that we had seen in the panic. The big carry trade risk off that took markets down, that took Japan down 12% in a day. We're now trading around the 141 level. And the NASDAQ, as you said, has bounced and has had 2 strong days of rally now. So the big question is, are we going to see this differential between the two narrow again? I'm undecided. You know, usually we know I'm the bear, the more cautious one. You are the bull. And I've worn a white top today because I'm neutral. I don't have my red
You're not
bearish
allowed to
hat
be
on.
neutral. You're not allowed to be.
It's just dull, isn't it?
Yeah.
I think the main reason I have for being neutral is the future's unwritten. You know, as Natasha Bedingfield would say, right? It's the future is unwritten. And we just don't know what this labor force is going to throw up. We don't know what US earnings are going to be next year. What do you think the earnings estimate for the S&P 500 EPS is in growth terms next year?
I don't know.
10%. With all the recession worries and, you know, have rates been too high for too long, we're still expecting 10% growth in S&P earnings. And that leaves us on a multiple of around about 20.5 times forward earnings, forward PE ratio. So I'm just nervous. I can understand the Goldilocks, and I can understand that the Fed have got a lot of bullets there that they can cut 7 times in the next 7 meetings. But is it too late? And do we see the lag effects? And do we see this, labor force increase that causes the consumer to slow? And I cannot see how we can get 10% earnings growth next year.
I think, should we necessarily care that far forward, though, is probably the question. Because right now what we're looking at is momentum, right? We're looking at a Fed who's willing to go 25 basis points for the first cut. We're looking at a Fed in terms of Jerome Powell as well, who's actually been fantastic at guiding the market on what he's going to do. There's been no surprises whatsoever. And I think whenever I look at the market, I'm looking at, okay, how much is this data or this speech going to cause volatility? And really what we've seen is the market getting too volatile before anything's even been said, which for me creates a constant buy the dip scenario. Every single FOMC meeting that we've had for the last 18 months has seen overbought volatility, which has been that reason to then get in front of it and just buy any kind of dip. We've seen it through August. I think there was less liquidity through August, which is why we saw a big cascade in the vol markets as well. And I think even this last week, we saw just yesterday, there was a big tick up as well in 50 basis points. It went to 51% chance.
Yeah.
Now it's trading 39%. So we're seeing it get slapped down again. Markets up. This has been a constant for so long.
This takes us on perfectly to the trading events that we've got coming up. Now, this week coming, the Federal Reserve meets and gives its interest rate decision, is it going to be 25 or is it going to be 50?
100% 25.
Yeah.
There is no doubt.
And isn't that funny? Is it, there must be a trade that we can both do off this, because I'm 100% on 25 basis points as well. Because exactly like you say, Powell doesn't surprise the market. And 50 wouldn't be seen as a gift, I don't think. It would be seen as a...
Panic.
Yeah.
Yeah.
And we don't know what it would cause. So I think it's 25, but I do think that he gives very dovish rhetoric along with it. So we might see the market come off on the announcement, on the figures that are given when they give their outlook for next year, what's going to happen to rates. But then I think in the press conference, he's very reassuringly dovish.
Yeah. I mean, look, he's been great, to be quite frank. No surprises ever with him. And I think, 25 is pretty much nailed on. And the fact that I don't really need to deliberate over whether it's going to be 50, whether it's going to be 25, the market's telling us now that it's going to be 25. We can see it all getting priced in here. That's what these last 2 days of rallying has been about, or one day, say, whatever. And I think it's very, very clear. Now, we might get, when we get to Tuesday, the market just pauses, comes off a bit. I think that's probably the most likely scenario. It's priced in quite a lot already. But then afterwards, what will happen? It'll probably be flat for a bit, tick on up. It's buying into Powell's nature of keeping that volatility nice and flat, in my view. Mm-hmm. So I think 25, I think it'll be a very simple press conference. I think people have been prepared for this for quite a long time. The next question will be December. And that is where I think the data over the next couple of months really comes into question, because what might happen is if there's one slip, people are going to be saying, oh, we need an earlier cut or something like this. They might say November, you need to cut. Right. And that is when I think we start seeing issues. But it's going to become very data reliant over the next month or two.
Well, do you think that we'll get a negative non-farm payroll print at some point?
I don't. And the reason why is I think as we come into that seasonal nature of things, Christmas hiring, things like that, I think we'll see things change. We've had a summer hiring spree and then that come off a little bit as we enter the autumn. When we ramp up into Christmas, I think that changes. I still think we see in line.
Now, as for ideas of the month, I think talking about Christmas, it sounds like you're going to be getting me a pair of trainers for Christmas.
Yeah, I absolutely love this company because it's interesting. It's kind of in context of what we were talking about with Nike, because the company is on holdings, on running. You might have seen their trainers.
Yes.
Now, I've done a quick sort of anecdotal survey here, and I've asked about 5 or 6 people, when you bought your last pair of trainers, did you think of Nike? They've all said no. And I asked them, what were the first pair of trainers that you thought of? They all said either On Running or Hoka. Mm-hmm. Now that tells you so much. Roger Federer backs this company. He's a shareholder. They have sales of nearly $2 billion versus Nike's, which is multiples of that. If we're playing a simple sort of narrative focus here, where my perception is that Nike's market share is decreasing, while incumbents like On Running, On Holdings is rapidly increasing, I think there's a case for their share price to go many multiples over the next couple of years. And I'm talking many multiples. I'm talking $10 billion of sales plus. I really think that. And they're doing things like inventing new technologies as well, which has Nike done that recently? They've created Flyknit, which is really more of a style rather than a technology. And so they're almost a tech company in the sports and fashion leisure brand sector. So I think they're fantastic.
It almost sounds like it would make sense for Nike to buy them.
Possibly.
They already own Converse. But just going back to On Holdings, so I believe that they're a Swiss company, but they're listed.
Listed.
Right, which is exactly what we spoke about earlier, isn't it?
Yeah, exactly. So it's nice because you don't have to hedge in anything related to franc, which is a trouble. So your shares are in dollars, but it's a really nice play, I think, on a company which you wouldn't necessarily think of as having massive growth. I didn't actually know they were listed until I started investigating, and I don't think a lot of people.
I was the same. Yeah, and it's very funny. So, although it looks like our living room, this isn't actually our living room here. And the way that we come up with the trades of the month is that we think of them separately. We don't discuss it, and then as we come into the studio, we can see each other's graph, or we talk about ideas. And fascinating, my idea is not the same company, but for the same reason. And I'm looking at Deckers, which is the owner of Hoka. So I'm going with Hoka, you're going with On. And I do actually have a short Nike at the moment because I think a profit warning has to come. And the only concern I have is that along with the profit warning on October the 1st, is when they come out with numbers, then the CEO goes. So John Donoghue, coming from a management consultant background, why do you have a management consultant in control of a fashion company? And he tried to turn Nike into a tech company and it's failed. They need to get back to basics. They need to, come up with the innovation because Jordan is dying. And, there's just, the innovation is completely lacking. They've split the company. Instead of it being running and lifestyle and women's training, they've split it into men's, women's and kids. And that's it. So you don't have this incredible expertise that people had in Nike at one point. So whereas Deckers, on the other hand, is exactly the same argument as On. I believe they've both got around about 2% of global footwear market share. Okay, so Nike's on 28, Adidas is along the lines 22, 23, and the two that we're talking about are only 2%. And everybody's buying them.
Growth potential.
Real growth potential.
Do you want to know something interesting about this sector as well? Is, let's say over the last couple of years, there was a move to be sort of inclusive, all kind of happy, fluffy, beautiful at any size type of thing, which is fine. I understand that. But you're a sports brand, okay? At the end of the day, the people who are buying your stuff are probably serious runners, athletes, etc. Now, Gymshark has just signed Chris Bumstead up as an owner of the brand. And Chris Bumstead, if you don't know who he is, he's Mr. Olympia, one of the most successful bodybuilders of all time. Now, sports companies have shied away from bodybuilders for obvious reasons. They take steroids and it's probably frowned upon. But now I think what we're seeing is a move back to eliteness, putting elite athletes at the forefront. Now, who did Nike get rid of as their ambassador? Tiger Woods. He is the epitome of elite. And now these other brands are going the other way. Roger Federer is an owner of On Running as well. So where there's these smaller brands that are really, really taking hold of that real elite nature of things, Nike, Adidas to maybe a certain extent, they don't care as much. And so I think people are noticing that now, and they really want to regain that sort of, I can be the top, I can be the best, rather than feelings at the end of the day.
Yeah. Okay, so, and do we know what share price they are at the moment?
They're nearly $50
okay.
at the moment. So
right.
They're trading, I think, $48.40.
Excellent.
I made a call a couple of days ago and it was trading 41. So it's done a
Whoa,
lovely move in 2 days.
Oh, well, I'm not giving you that.
Yeah, no, that's fine.
I'll let you in at 4 to 8.
That's fine.
And so $900 for Deckers. And they do Deckers' own Uggs as well. So there are some other things in there, but Hoka's the great growth engine. So $900 on Hoka, and then 4 to 8 on Holdings.
Call it 48.
And we'll review. I very much look forward to reviewing these trades next month. Let the competition commence.
It'll be good fun.
So that's it for this month's edition. Thank you very much for joining us, and we'll see you again next month.